A lot of Canadians think that they actually need to save 20% down payment to avoid mortgage default insurance. But here's the problem. In parts in Canada, home prices have historically risen faster than most people could actually save. So while you are waiting to hit those 20% down payment, the house you want often gets more and more expensive. In this video, I am breaking down the numbers. 5% down VCMHC insurance versus 20% down payment without it. So you can see which option actually makes more sense for you. Let's start with 5% down. The biggest advantage of putting 5% down is that you can get into the market faster. Take $500,000 home, it's 5% down payment. You get $25,000 with 20% down payment. You will need $100,000 down payment. If you are saving $1,000 a month, $25,000 will take you 25 months, which is basically 2 years. If you need $100,000, it's 100 months, which is basically 8 years. That is 6-year difference. You could be building equity in your own place instead of paying rent. Now imagine home prices go up approximately 3% per year while you're saving. That same $500,000 home becomes roughly about $546,000 home after 3 years. About $597,000 home after 6 years, and about $635,000 home after 8 years. So while you're trying to hit the 20% down payment, the price is just drifting away from you. And the down payment you need keeps getting bigger and bigger. Insured mortgages, which means less than 20% down payment, have often better interest rate than conventional mortgages with 20% off. For example, let's use a simple numbers. An insured mortgages at 3.6%. A conventional mortgage is a 3.9% interest rate. On $500,000 mortgage over 25 years, at 3.6%, total interest paid, it's $288,000. At 3.9% total interest is about $313,000. That is around $25,000 more that you're going to pay in interest, just because the rate is higher on your conventional mortgage. The biggest downside of 5% down payment is that insurance premium. Back to our $500,000 home. Down payment is $25,000. Mortgage before insurance is $475,000. But then we need to add insurance to it of 4%, which is $19,000. So now the total mortgage that you're taking is $494,000. You're borrowing that $19,000 extra, and you are going to actually pay interest on that amount for those 25 years of amortization. It's 3.6% over 25 years. That $19,000 ends up costing you $27,000 once you include the interest. And let's go into the next column, higher monthly payment. Because you're borrowing more, you're actually taking on more mortgage, your monthly payment obviously is going to be higher. So on the same $500,000 home with 5% down payment, your mortgage is $494,000. So your monthly payment is going to be around $2,400 per month. With 20% down payment, you are taking $400,000. And your monthly payment is going to be around $2,000 per month. That is roughly $400 per month. Let's go into another con with 5% down. You start with a very little equity. So on that $500,000 home, 5% down, you own only $25,000. With 20% down, you own $100,000. So this matters if you need to sell quickly and have to cover real estate fees and closing costs, or you really need to refi or get home equity line of credit later. You usually need at least 20% equity in your home for that kind of flexibility. All right, So those are the pros and cons of putting 5% down payment, basically the minimum down payment. Now, the pros and cons of 20% down payment. This is the traditional approach a lot of people still aim for, to put 20% down. The big benefit is super simple. With 20% down payment, you avoid mortgage default insurance completely. So on $500,000 home with 5% down payment, we had that CMHC fees of $19,000. With 20% down payment, that number is zero. And so that $1,900,000 now is not added to your mortgage. Another pro is your lower monthly payment, of course, because you're borrowing much less. Your monthly payment is lower. So on $500,000 home, 5% down payment, your monthly payment, as we mentioned before, it's $2,400. 20% down payment, it's $2,000, and you're paying now $400 less. It's about $5,000 per year, which can be quite significant. And the pro number 3, you have more equity in your home from day one. Later, you may be able to access of that equity through the refi, home equity line of credit, obviously depending on your lender rules and your specific situation. Let's go into our last pro, more lenders options and actually more flexibility. So with 20% down payment, your mortgage is called conventional mortgage. It's not insured mortgage. That often means that you have more lenders to choose from because some lenders only want conventional files, and in some cases, lenders may be a bit more flexible with things like how they look at your other debts, variable self-employment income, and obviously rentals. For rentals, you will have to put 20% down payment. When you put 20% down payment, you can make some lenders more comfortable to actually approve you for more money than when you put only 5%. So let's go into the con number 1. It takes longer to save. As we mentioned before, the biggest downside is your time. During those years that you are saving, the price and they are going up, you might feel like you are chasing a moving target. And also there is an opportunity cost. If you use all your savings for the down payment, you actually cannot invest that money anywhere else. Let's say you have $100,000 saved, you put 5% down, you use $25,000, and then you're actually left with $75,000 that you can go and invest. It grows at 6% per year over 25 years versus your mortgage that is 3.6% over 25 years. It can grow for more than $300,000. By putting all the money down, you might be giving up that potential growth. You really should not put down 20% if it leaves you with $0 in the bank. A good rule of thumb is to keep 3 to 6 months of expenses in emergency fund. Now, let's put the numbers side by side on a $600,000 home. We will use an insured rate of 3.6% and conventional rate of 3.9%. We're going to amortize that on 25 years. We are looking at total down payment of $35,000. So mortgage before insurance is $565,000. Insurance is 4%. So we are going to add $22,600, which makes your total starting mortgage $587,600. So with 3.6% over 25 years, payment is about $2,950 per month. Total interest over 25 years, we're looking at approximately $229,000. Mortgage plus interest is about $885,000. And the down payment is $35,000. Your total out of pocket is about $920,000 by the end of 25 years. If you put 20% down payment, same purchase price of $600,000, down payment of $120,000, mortgage amount of $480,000, no CMHC fees, 3.9% interest rate over 25 years. We are looking at a monthly payment of around $2,500 per month. Total interest is about $260,000. Mortgage plus interest is about $747,000. Add the $120,000 down payment, and your total is about $867,000. Total cost, including down payment, it's about $920,000 versus $867,000. With 20% down payment, you're saving approximately $53,000. So on paper, 20% down payment kind of wins right now by about $53,000. But that's not the whole story. Now we add the opportunity cost. Remember that $85,000 you needed for 20% down payment? So if you invest that $85,000 at 60% return over 25 years, it can actually grow to $365,000. So you saved $53,000 by putting 20% down payment, but you gave up on $365,000 of investment growth. In this example, you are about $300,000 better off if you put that 5% down payment and actually took the rest of the money and invested. The key, of course, is that you really have to invest it, not spend it. So we actually have that sweet spot of 10% down payment. Let's talk about that. CMHC insurance premium are tiered, as we mentioned before. So on a 10% down payment, we are not paying 4% anymore. We are paying approximately 3% now. Okay, so let's use the same $600,000 home with 10% down payment. The mortgage is $540,000. And insurance is 3.1%. So we are going to add $16,000. That's actually savings of almost $5,000 in insurance premium. And you only had to add not $75,000, but $25,000 of your down payment to move from 5% to 10%. So you put that extra $25,000 and you saved almost $6,000 just on your insurance premium. That is actually 23% return on that extra $25,000 before you even look at the total interest saving. That is why I call 10% down a really nice sweet spot. You still get into the market fairly quickly, you reduce your insurance cost, and you can still keep some cash aside for emergencies. So which option makes sense for you? Here is a simple way to think about it. Choose 5% down if you want to get into the market as soon as possible. You have limited savings, maybe under $50,000. You want to keep cash for emergencies and renovations, and you're comfortable with a higher monthly payment. And you actually plan to invest the difference, not just spend it. Choose 10% down if you have a moderate savings, you want to reduce your insurance cost, but still get quickly into the market. You like that balance in between speed and cost and safety, and you still want a bit of cash left over for emergency fund. Choose 20% down if you have a significant savings. If you want the lowest monthly payment possible, you want the maximum buying power and more lender options. Obviously, you will have to put 20% down payment if you are buying a property above $1.5 million, where 20% is absolutely required. Here's my personal take. For most first-time home buyers in Canada, 5 to 10% down is actually often makes lots of sense. You get into the market faster, you start building equity sooner, you can still benefit from appreciation of your home, and you keep some cash for real life curveballs. Thank you so much for watching, and see you in the next video.